Hey everyone, welcome to another video on my channel, and in this particular video we are going to discuss about how we can adjust long-term option trades. Previously we had already created a series on short straddle where we discussed how we can enter, adjust and exit intraday and positional short straddle. Later we also started out with a series on long-term option trading, and we had made first video where we showed a different perspective to entering long-term option trade. And this is going to be the second video in the same series where we are going to discuss how you can adjust your long-term option trade. So whenever you trade with long-term options and the market moves violently, you might have to manage the existing position. So that's the reason this video is divided into two parts where I'm going to show you how you can manage your non-directional long-term option trades and also how you can manage your directional long-term option trades. So both will be covered in this video, and I will be showing you in detail what are the different adjustment methods we have. So with that, let's quickly move on to the screen recording and try to understand this better. Meanwhile, I also want to tell you one more thing. We have started a new Telegram channel where we'll be sharing our trade insights. So as and when we take the trade, we'll share the trade and also explain the logic behind it. So if you're interested, you can definitely join the Telegram channel, and the link has been attached in the description below. And one more thing before we move on is that in case if you find value from this content, please do not forget to hit the like button, because it is just a minute of task for you, but it is going to make a huge difference to us. So please hit the like button right away and also subscribe to the channel. Thank you so much. Hey everyone, welcome to this video. And in this video, we are going to discuss about managing long-term short straddles. In the previous video, we had already discussed about introduction to long-term short straddles, how we can create long-term short straddles, and what are the things that we have to keep in mind before creating long-term short straddles. In this particular video, we are going to focus on what are the things that we have to keep in mind while managing our long-term short straddle, and also in case if something goes wrong, how we can adjust the position. So now let's quickly get on to the first part of time frame. So right over here, I have opened chart of Nifty. Now, whenever we are doing long-term short straddles, let's say for 3 months, 6 months, or even a year, what is the time frame of the chart that you have to actually look at? Is it that you have to look at 5 minutes chart, 15 minutes chart, or a daily chart? In my opinion, the minimum time frame which you must be following for adjustment of any long-term short straddle is weekly. So in case if you're doing any trade for 6 months or above, weekly should be the minimum time frame what you're following. So right over here, I have opened the weekly chart of Nifty. And now, if you remember from the previous video, I had suggested doing a 21,000 short straddle for December. So this is again not a trade recommendation. This was just my personal opinion that I would be doing a 21,000 short straddle in case if I was taking a December end trade. I had also given reasons why exactly I would be going ahead with that. So now if we open NSE option chain for a December end 21,000 short straddle, right now we are pricing in close to around 1350 points. So that would be around 200 rupees on the call side and 1200 rupees on the put side. So overall close to around 1350 rupees as the overall premium. Looking at the chart, where do we end up adjusting this particular short straddle? So, as I told you in the first video, when you do long term short straddles, the amount of adjustments what you have to do, or the amount of times you have to track the market, is going to reduce by a huge margin. Which means, since we have a bullish position, we don't have to worry about the markets going up. So if the market is going to 20,000, it is good for us. If the market is coming to 21,000, it is even better for us. So our only worry is what if the market actually ends up coming down. So instead of going towards 2,500, what if it comes towards 18,500? So that is what the real problem is. So that's the reason. First, we are going to see where we can end up adjusting in case if something goes wrong. Because we have a bullish position, we really don't have to worry about the upside. And downside, all I have to do is mark a important support zone. So looking at this particular chart, so I would be marking my support at 18,600. So why exactly I have marked at 18,600? In 2021, market had made a swing high of 18,600. From there, it retested again in 2023, beginning of 2023, and finally in July 2023, we broke the swing high, retested, and finally went up from there. So for me, 18600 is a very important support zone, and I don't expect Nifty to break 18600 that easily. So given this particular thing, I wouldn't be doing any kind of adjustments till we see a close below 18600 on a weekly basis. So this is why I told you in the initial video also, if you are doing any kind of long-term short straddles, the amount of adjustments or the time you track the market is going to be very little. So you do not have to track the market on a daily basis. You can just open the weekly chart and follow the market every Friday around 3:15 just to see where it is closing. Given that market doesn't break 18600, it is pretty good for us. But what if it ends up breaking? So now I'm going to tell you how you can adjust your trades in case an event like this happens. So you are going to track this on a weekly basis. So most likely you are going to see next Friday and the coming Friday to see where the market is closing. And assuming that the closing happens below 18600. So then what are the options we have to adjust this particular trade? So now I'll be focusing on teaching you two adjustments what you can use in different scenarios. I will also tell you under which scenario you can use which kind of adjustment. The first adjustment is nothing but re-entry. So what exactly is re-entry? Re-entry simply means to cut your old trade and re-enter a fresh trade. So initially I had a 21,000 short straddle, right? In case if the market breaks 19,600, that means my view has gone completely wrong. I had taken a bullish short straddle, but now the market is falling and my view is totally wrong. So that means there is no point in holding this trade and trying to adjust again and again, because you know for a fact that on the call side you don't have enough premium. So when you look at the call premium, it is around 200 rupees and the put premium is almost around 1200 rupees. And this is a directional bet, because of which if you go wrong, right, you don't have a lot of ways to adjust this because there is no premium on the call side. And that's the reason it is simply better to exit the entire trade and enter a fresh trade. So if you are betting that the market is going to go to 22,000 by December end or come to 18,000 by December end, and if you get your view wrong, you can simply do this re-entry. So now we spoke about exiting the trade. But where exactly are we going to re-enter our trade? So let us assume the market has actually come down till here. So now when we take a look at the charts, I know for a fact that now 20,000 is going to be a very strong resistance because the market tried to break it, but it was unable to break and we saw a sell off. But on the downside, I also know for a fact that 17,000 is going to be a very strong support. So previous to this, I was extremely bullish, expecting the market to go towards 21,000. But now my view has changed to range bound. I am expecting the market to trade between 20,000 and 17,000. So that's the reason I would simply go ahead by creating a 18,500 short straddle, which is a range bound short straddle, instead of creating any directional short straddle. So it can be either 18,500 or it can be something like 19,000 short straddle instead of creating a directional short straddle. So this is one way how I can end up making the first adjustment. So as soon as my view goes wrong on a weekly basis, I will cut my directional trade and simply convert that into a fresh range bound trade. So by doing this, again, I will have a break even of almost close to around 1000 to 1500 points. And this is going to give me a sufficient range to trade. Re-entry is nothing but exiting your directional trade and re-entering a non-directional trade. The second type of adjustment is a very popular adjustment, which is nothing but shifting. So this is the adjustment which can be followed in case if you have taken a long-term non-directional bet. So what exactly do I mean by this? So now let us assume you had done a 18,000 short straddle of December end sometime in the month of January. So for this, I'm just going to take you slightly back. So I'm going to click on the replay bar and let's go to the month of January, right? So assuming that you had done a 18,000 short straddle in the month of January. So this is a total non-directional bet. So you would have got more than 2000 plus points, or even I think close to around 2500 plus points. And if I were to mark my support and resistance, the resistance would be somewhere around 18,600 and the support would be somewhere around 17,000. And once, if the market breaks either 18,600 or 17,000, I can simply end up shifting my long-term short straddle. So I will tell you what exactly that means. Let us try replaying the chart. So right over here at this candle, the market has decisively broken above the range what we had marked. So we had marked 18,600 and it is decisively above the range. And here is where we are going to do our first shifting. Because the market has broken the resistance, there are higher chances the market can actually go up. So now we have a 18,000 call option and a 18,000 put option. So for almost close to around 6 to 7 months, you didn't have to do any kind of adjustment because the market was trading in the range you had marked. But now after 6 months, finally the range is broken and you can simply cut your call leg because the market has broken on the higher end. If the market had broken on the lower end, you could have simply cut your put leg. So simply cut your call option and shift to a slightly bullish trade. So you have a 18,000 put option. Now you can simply go and short something like a 21,000 or even 22,000 call option and convert this into a completely bullish trade. So now assuming that the market had actually broken on the downside. So instead of crossing above 18,600, let us assume the market went below 16,800, right? In this case, there are higher chances the market can actually go down. So all you have to do is simply cut your put option, which is a loss making leg, go to the nearby support, which can be somewhere around 14,800 or 15,000, and short a 15,000 put option. So you are going to have a slightly bearish trade where you are going to have short in 18,000 call and short in 15,000 put. So this is one of the easiest way to adjust your long-term short straddle. So the good part about these short straddle adjustments are you are not going to get a lot of adjustments. So you are hardly going to get maybe 3 to 4 in the entire trade because weekly charts are not something that easy to be formed and you have a pretty broader range to work around. So now you can use the normal rules of shifting. So in case if the market comes down further, you can shift your 18,000 calls closer towards 17,500 calls. So you have multiple options on how you can work around once you have done the initial shift. The summary of adjusting long-term short straddles is quite simple. First, if you have taken any directional trade, simply mark the important level of adjustment. So if you have taken a bullish trade, mark the important support. If you have taken a bearish trade, mark the important resistance. And once the resistance or the support is breached, because it is a directional trade, exit the whole trade and re-enter a fresh trade. So this is the first part. The second part is assuming that you had started off with a non-directional trade. Then mark the support and the resistance, and once you go wrong, simply cut the loss-making leg and push it farther away. So these two are simple rules of adjusting the long-term short straddle. So I hope you found this video informative. So the next obvious question would be, when do we end up exiting or when do we book a loss? That is something which I would be covering in the third part of how you can create, adjust and exit your long-term short straddle, with which we will also be concluding this series. I'll also be covering other aspects like position sizing, risk management, and how you can position size based on the risk to reward your trade has. Various factors will be taken into consideration, and I'll be teaching all of this in the next video. So I hope this video was informative and you also got some insights out of this. If so, then do not forget to hit the like button, share this video, and subscribe to my channel. Thank you so much for joining.